So if I'm paying all of this money each month, it's not on my P&L. It goes to reduce the liability. The single largest asset that you own is not on your balance sheet. That's your customer list. That will skew all of your debt to equity numbers and everything else, because balance sheets or accounting is recorded at historic costs. If you built a customer list, that's not on your balance sheet unless you purchased the company. So that, to me, throws out everything except a few that I thought were important: the debt ratio. And when I look at the debt ratio on a pest control balance sheet, all that tells me is the equity that you have in your fleet. Because the biggest hard asset that you have on your balance sheet is your fleet, right? So a debt ratio would be total debt divided by total assets. So, it's kind of like the mortgage on your house. Your house is worth $500,000. You have a $400,000 mortgage. So you have 20% equity in your house. It's the same thing. And I have some numbers on that. The current ratio, I think that's important because that shows whether you can pay your bills or not. And same with the quick ratio. And I'll explain that. So the current ratio is basically current assets, which is basically cash and accounts receivable and inventory over accounts payable, maybe credit card payables, short-term monies that you owe quickly. The quick ratio is just cash over current liabilities. That's a misprint, right? The AR. Okay. Now, debt ratio, what we're seeing is that mostly people own about 1/3 of their fleet and the bank owns 2/3. Okay, that's basically what you're seeing here. The current ratio, this was kind of surprising and it was higher than the last cost study, was that the current ratio is probably about 1.5. That means that there's 1.5 times current assets to pay off whatever liabilities that you have. And then the quick ratio is still over 1.0. And the reason that a healthy company in most industries would be over 1, so that people would say, geez, you got to be able to have at least enough money in the bank to pay your bills. But in a recurring revenue business, you're always bringing in money. So you could actually go with a current or a quick ratio of less than 1. But my study found that it was not less than 1, that it was about 1. And the other one is, if anybody has any loans with the bank, SBA loans or other loans, there's something called times interest earned. That's a ratio. It's usually buried in some covenant in the loan document. And when you breach it, your bank will tell you that you're in default, even though you're paying your bills. But basically, what that means is the profit, can you pay the debt service, right? And how many times over? So in other words, for Mid-Atlantic, we have enough profit, 3.73 times profit than the debt service that we have to pay, which it's kind of interesting. So remember, net income is not and cash flow are two different things, right? Because what's not deductible? Debt payments, right? So if I'm paying all of this money each month, it's not on my P&L. It goes to reduce the liability, which means that from a net income perspective, you're making a bunch of money, but you might not be, flush with cash.